In this video, we're going to have a look at Heineken, which is of course one of the more famous beer brands in the world. They have of course the brand of Heineken itself, as well as some additional brands like Amstel, Sol, Tiger, Birra Moretti, Edelweiss, as well as many more. Now, and what most people might actually not realize is that Heineken is also the biggest cider brand in the world. They own brands like Strongbow, Orchard Thieves, as well as Stassen. So let's have a look here at what Heineken has been doing with their financials for the past 10 years. And let's see whether or not we think that Heineken is a good investment to buy right now and hold for a decade. So when we look at their revenue, I think the first thing that strikes me already is that I see very consistent and very much growing numbers. So this is very much what I like to see, because it makes it a lot more simple for us to project a company like Heineken into the future. So what we see here is a revenue growth of about 3.8% every single year. So of course this shows, while even though they are already a very existing brand, they're still able to get additional market share and to expand their operations, which is very nice to see. So looking at their EBITDA, their earnings before interest, taxes, depreciation and amortization, basically the bare bones earnings that they have before any additional accounting practices, their raw bottom line. So when I look at these numbers, it shows a very similar story to their revenue, which is to say that their earnings have been growing steadily for the past 10 years, and they don't really show many big hiccups every now and again, which I guess makes sense. Whether or not the times are prosperous or maybe they're a bit more hard, people will always want to have a drink with their dinner, and people will always want to have a beer in the pub. So we see that very much reflected into their revenue and earnings growth as well. And what we also see here, that their earnings have been growing a little bit faster than the revenue has, which does mean that they have been able to increase their margins for the past 10 years, which is also very, very nice to see. When we look at that debt level, we notice that the debt level hasn't really changed in the past 10 years, which I'm very happy to see, because I think that debt level is towards the medium size already anyway, so very much would not like them to expand this number, and in all fairness they haven't really. Some years they're paying down, most years they're borrowing a little, but again their EBITDA is growing as well, so I think that's completely fair for them to do. This brings us to excess cash. They always have some additional cash on hand, like here in 2020 where they borrowed some and they just left it sitting on their balance sheet for a rainy day. Market cap, the price as seen on the stock market itself, has been increasing year over year by about 7%. Now this does not include dividends, of course. This does not include any form of free cash flow. This is the pure stock price as seen on the open market. So when we look at enterprise value, and enterprise value is the market cap to which we then add the debt and subtract the cash, and we can see here that the enterprise value has been growing less fast than the market cap has, which means that the debt and market cap ratio has been coming down. The market cap has been growing a lot faster than that debt level has. So this is very nice to see. It's also what we've seen previously when we noticed that that debt level has been quite steady. We also see that reflected into the enterprise value. So this then brings us to the EV/EBITDA ratio. How many years of earnings does it take for Heineken to buy back the entirety of their enterprise value? And what we can see here is that by and large they have been between the 7.6 and 17.7 times, where I think 17.7 times was quite the outlier because of the low earnings that they had in 2020. But by and large we see a very steady trend between the 9 to 12 times ratio. Looking at that net debt to EBITDA ratio, we can see that they've been consistently underneath the 3 times. Of course, in 2020, when the earnings were lower than expected, they had some higher multiples, but it quickly came down afterwards, and they also started to pay down some additional debt here in 2021 to kind of make sure that this doesn't really happen again. So I'm going to give them a pass when it comes to that debt level, but I would still like them to pay down their debt a little bit to kind of reduce this leverage ratio that they do have. Although it's like not excessive, it's I think it could be a little bit lower. So this brings us to their cash flow. Just looking at the cash flow from operations, it shows a very similar story to what we've seen with revenue, what we've seen with earnings. So it means that their cash flow from operations has been steadily increasing for the past 10 years. Steadily, with a quite record number. Well, not quite a record number. The record number was in 2018, but 2021 was definitely a high number as well. When it comes to the capital expenditure, now this is all the maintenance costs, all the planned costs, and also the purchasing of additional breweries or storage facilities, or basically anything that they really need to keep future-proofing their business. And what we can see is that their capital expenditure has been increasing by about 1% year over year, which is comparing these two numbers mostly, right? So of course they did see some higher numbers here in between, but they've been able to reduce that for the past 2 years, which is a very nice way for them to increase the value of their free cash flow. Look at what they've done with debt. We can see that by and large they've been borrowing a little bit, but they've also occasionally paid it down, and that's why they are quite at the steady level here in this particular column. So this brings us to free cash flow. Now I included to not use the change in debt in their free cash flow statement because I just want to know what they produce themselves without borrowing or paying down additional debt, because I do not think that is representative of their business as a whole. So looking at their shares outstanding, we can see that their shares outstanding has been steadily holding at 575 million. Not much to say about that. Free cash flow per share. So the amount of free cash flow divided by the amount of shares is of course then equal to the free cash flow because the shares have been remaining stable. And what we can see here as well is a very steady growth in their free cash flow per share, starting with €2.65 and risen all the way to €6.66. Now this number was quite a record for them, but 2018 and 2019 were quite similar to that as well, and of course 2020 was a bit of the odd one out. So I think by and large we see a very similar trend here with earnings, with revenue, as well as with their cash flow from operations. So kudos to Heineken really for continuing to see this growth in their company. Looking at the price per share as seen on the stock market itself, we can see that they had a price per share of €50.47 10 years ago, and in 2021 they reached a share price of €99.58, an historic record for them. Looking at their free cash flow yield percentage, we can see that they've been circling around the 6% mark, ranging between 5.5, 5.2, as well as 4.1 here. Of course, they're very low earnings as well as cash flow number, and the highest number they've posted was 8.3% here in 2018. So this then brings us into the business of trying to project this company into the future. So looking at the earnings, what we see for the past 10 years is that they've been steadily increasing their earnings. Right? I think 2021 was a bit of a very fast increase compared to previous numbers, but nevertheless, overall they've been growing by about 4.4% every single year. So because I think this last number here is a bit of an outlier, and the moment that I try to normalize that to be more in line and kind of cut away the COVID stimulus, the COVID effect that most companies have seen, I get about a growth of about 3%. So this is what I'm going to do for Heineken as well for the additional 5 years coming up. I'm going to give them an EBITDA growth of 3%, and I'm going to reduce that by 2% for the 5 years after that. Because I'm not sure what the future will hold, but I do think Heineken is a very big brand already, and I think their growth potential is decreasing the bigger they become. When it comes to a market multiple, historically they've always been around the 9 to 12 times ratio, where I think 17 times was a bit of an outlier. So I think it's fair to say, given that their earnings and growth has been very steady, to also give them an 11 times multiple in the future. And this gives me an enterprise value 10 years from now of 94 billion, to which we subtract the debt, add the cash, gives me a market cap of 93 billion, divided by the amount of shares outstanding, gives me a stock price 10 years from now of €144.31. So with free cash flow, I'm going to do a very similar thing, which is to say that I'm going to take the number that they've posted here in 2021. Even though it's a record number, I do notice that they came quite close to this number 2 years before that. So I don't think it's really a stretch to say that this is probably the free cash flow level at which they're currently operating. So I'm going to take this number from 2021 and I'm going to increase it into the future, starting with 6%, and for the final 5 years I'm going to give them 5%. Now historically they've been doing 10% every single year, but I do expect those numbers to come down a little bit because I want to be conservative with my estimate anyway, and the moment that my conservative estimate beats the stock market, that's when I'm going to be interested in buying the stock. So I'm going to say a 6% free cash flow per share increase for the next 5 years, and then a 5% increase for the 5 years after that. I'm going to add a 7% free cash flow yield to this as well, which I think is what they've been doing historically by and large. Now, of course, they also had much lower free cash flow yields here, like in 2020 of 4%, and also in 2012, 2013, and even 2015. So I think when it comes to that, I think 7% is probably a bit more towards the conservative side of their average numbers for sure. And the moment that you believe that it might actually come down a little bit, what you notice is that the stock price 10 years from now is going to increase. But I want to have this little bit of conservatism in my projection. So right now on the stock market, I can buy as many shares of Heineken as I want for €95.66. So if I take my two projections here of 144 euros for the enterprise value model as well as the 164 euros for the free cash flow model, I get an average share price 10 years from now of 155 euros and 19 cents. Now, simply looking at the price on the stock market itself, I expect this to give me a return of 5% every single year. But of course, Heineken is very much a cash flow machine. They produce a lot of free cash flow with which they can reward their shareholders in the form of dividend, in the form of share buybacks, in the form of additional acquisitions or expansions. Now, they've very much been paying out dividends and been doing some expansion to keep on increasing their revenue. So that's how they've been spending their free cash flow by and large. And of course, this free cash flow belongs to you as the equity owner. This is your pro rata ownership of the company. So the moment that we include that free cash flow into our calculation, we get an IRR, an internal rate of return of 14.6%. And this 14.6% includes all the free cash flow that we outlined here in our free cash flow projection. So first we buy a share for 95 euros, we get the free cash flow for the next 10 years, and then we sell the share for 154.19 cents 10 years from now, and that gives us an IRR of 15%. So let's see what happens if the stock price comes down a little bit or goes up a little bit. So the moment that Heineken's share price starts to come down about 30% to 70 euros, I expect an IRR of 19.1%. And the moment it goes up a little bit, even to as high as 114, it still gives me an IRR of 11.8%. Now, I always say, on average, the stock market returns about 10% a year. So even if Heineken goes up a little bit, I still think it's a decent market returning investment. I don't think it's a high risk investment, and therefore I also don't think there's a high reward. But they do have a very steady earnings, a very steady revenue, and of course, because of that, a very steady free cash flow. So the numbers that I gave Heineken here were a bit on the conservative end, but I think towards the conservative end of their historic averages. I don't think it's too conservative by any way, shape or form, and I think this is quite a fair projection of their future financials. So this was my stock analysis for Heineken. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!